Oh, yeah, is it we have? Okay. Hi, good morning, everybody. It is the appointed hour to have the highlight of your day, talking about GASB 94, 96. You can feel, I think, the excitement in my voice right now, which is why I'm not the primary trainer on this topic. So first off, my name is Rob Hamilton. I'm the statewide accounting reporting services manager. It is so great to see so many people here. I got to say, when we put this together as an in-person, we were going, how many people are going to sign up? We got the recorded training. What's it going to be like? This is the first time we've done an in-person training in 4 years, so we may be a little bit rusty, but you are in good hands with Brady here. But I just wanted to say welcome and thank you for coming. I think everybody has signed up, but make sure you do the sign-in sheet if you haven't yet. That's how we're going to check for Gold Star purposes. And also, please make sure that you have the exercises, which we're going to go through in a little bit, that we'll go through for some of the GASB 96 scenarios. I also wanted to introduce the team. As many of you know, we've had some changes in staffing, so it's a good opportunity to put some faces to names. And please, if you haven't yet, please come up and say hello to your STARS analyst. It is really nice for us to get a chance to connect with you, maybe beyond just an email or to see on the other side of a screen or something like that. So with that, I will start here. This is Brady Stutzman. He is our Senior Financial Reporting and Policy Analyst. He'll be leading the training today. He joined us in July from Grove, Mueller & Swank, which is an audit firm here in Salem. He's got about 10 years of experience as an audit manager, so brings a wealth of expertise from local government experience and been on the audit side, so he's helping keep us out of trouble, which is, I think, we all like with the auditors. Moving on here, this is Valia Rizzo. She's a senior accounting analyst with us. She joined us in March of 2022. To her left is Sherry Keller, an accounting analyst. She joined us in May of 2021. Then to her left is Heather Klein. She joined us in February as an accounting analyst. And then to her left is Kathy Watson, who came to us from OLCC. So she's going to be on the other side of the table, if you will, doing some of these trainings in the future. But without further ado, I'll turn over to Brady. But again, thanks, everyone.
Also, if you are wondering, we almost matched today, and I almost wore that exact same thing that he's wearing. So it would have been kind of like a uniform type thing. But either way, I guess he already kind of introduced me a little bit here, but I'll do that again. So my name is Brady Stutzman. I am the Senior Financial Reporting Policy Analyst. And if you're wondering, yes, I did put my title up there because I figured I would forget as soon as I stand up here in front of all of you, and, you know, just from shock of talking in front of people. But so before coming to the state, I graduated from Oregon State University and then went straight to Grove, Mueller & Swank, which is a couple blocks that way, actually, if some of you are familiar. And, you know, was there for about 9 years before coming to the dark side of government, if you will, and haven't looked back. But I guess actually that might depend on how much of a fool I look in front of all of you. I might run back, but I guess with that being said, I tried to break the ice a little bit with a video clip here. Let's see, hopefully it's not too loud. I didn't get to test it before coming in here, but I don't have a mouse either, so bear with me. Maybe some of you have seen this. This is a clip from Windows 95 launch party. I can't hear it. Oh no. So I put that in there kind of as an icebreaker, but I also had a thought for about a split second of having the whole SARS team up here reenacting that and having I figured, you know, seeing their faces right now, they wouldn't have been too happy about it. But mainly, so I wanted to, I'm thinking about maybe watching it again, but this time picture Rob as Bill Gates. You're not. No, I won't do that. Same here. So, okay. So now that we've gone through that, let's get to the fun stuff, huh? So as you know, we are touching on GASB 96 and 94 both at the same time because for, well, two reasons. They are both new this year and also because they're generally related to leases, right? So as we go through this, I'll make several references back to leases because, you know, a lot of the requirements are very similar. So and it's kind of like a good framework because we're all experts on leases now, right, after last year. First one we're going to go with or go through is GASB 94, which is subscription-based information technology arrangements, or SBITAs, and I'll probably just refer to them as SBITAs from here on out because I don't want to say that every time. We're going to have a quick summary and then talk about the determination and applicability of it, measurement and calculation, go through some examples, some implementation, the disclosures that we've created, as well as some GASB Q&As that we came across, and then some key takeaways and exercises. After that, we're going to get into GASB 94, which is the public-private and public-public partnerships, which you may see as P3 or PPP. I'm most likely only going to refer to them as P3s because, again, I don't want to say all that every time. But if in the standard or other areas, you might see references to PPP as well, but just know that they're the same thing. And then also we're going to touch on availability of payment arrangements or APAs. Those are yeah, I'm gonna turn my speakers off, so hopefully the recording will keep going. With GASB 94, we're gonna kind of touch on the same things. We have a summary and then a decision tree that we created, as well as determination of applicability, and then some measurement areas, and then some other notable items and examples and so forth. You'll notice that we're going to spend most of the time on the first section because that's going to be more prevalent to most of you, I would believe, but we'll talk more about 94 as well. I put a lot of information in here, but we're going to kind of probably gloss over a lot of it and put more focus on GASB 96. So as I just mentioned, Rob had a good example with these where you think of the three of these as the three legs to a stool. They all kind of relate to leases, and so we need to kind of compare them all at the same time. So I included the lease definition here. I'm not necessarily going to go over it because we're all experts on it. So first, we're going to start with the SBITA, and then we'll come back and look at the definition for P3s. But for a SBITA, the definition is a contract that conveys control. Control is the important aspect here of the right to use another party or a vendor, their IT software, alone or in combination with a tangible capital asset, which otherwise known as the underlying IT asset, as specified in the contract for a period of time in an exchange or exchange-like transaction. If you notice, real quick, in each of these paragraphs, you'll see the word control. Control in lease, control, can you see my mouse? Yeah, so conveys control, conveys control, conveys control. So remember that when going through your contracts, make sure that you have control over the asset, and we'll kind of touch on that here in a second. But in other words, a SBITA is a contract in which your agency is using IT software, which may also include a tangible capital asset as well, for a fee without granting a perpetual license. Now, if you think about it, before you'd pay once for like Microsoft Office, right? That would be a perpetual software. SBITA is a recurring payment that you would see with like Microsoft 365. And so recurring would mean monthly, annually, quarterly, etc., anything like that. But the important thing to note there is if you don't make the payments, you don't get to use the software. So, I mean, really recurring, it can be, I just wanted to emphasize that it could be any type of recurring. It could be even annual or whatever. GASB 96 does not apply to these areas. So it would be leases or P3s, which are GASB 87 or 94. They don't apply to perpetual licenses for vendor software, like we just talked about with Microsoft Office. And they don't apply to contracts in which governments provide IT software to other entities through SBITAs. So that would be like the government as the lessor of a SBITA. We're talking about only for lessee. You're the lessee of the SBITA. So isn't there like a Janet Jackson song called Control? I just remember that because when I was studying for the CPA exam, they would always talk about, or he would always bring up that song because Control, he'd always sing it. It was really annoying. I'm not going to sing it, but it helped me remember, right? I mean, just remember that Control is the important aspect. So in order for a SBITA to apply for you, you have to have control. And what does that mean? It means you have to have the right to determine the nature and manner of the underlying IT asset, and also right to obtain the present service capacity for the underlying IT asset. So from there, once you determine you do have control, you would need to determine the subscription term, right? So ideally, 12 months or less, you'd expense it. You wouldn't have to do anything. You expense it, you're done. There is a 12-month exclusion that is in the standard that says something similar to if the term indicates that it's 12 months, but has an option to extend the term in any amount, like another 12 months or something, then you would have to assume that the term is 24 months, making it not short term. I think that's kind of GASB's way of making it so agencies or governments don't say that it's short term, even though it's not, right? So keep that in mind. If there is an option, you need to, it's a maximum possible term is what they call it. So keep that in mind. If there is a possibility to extend, it's not short term, even if the initial term is 12 months or less. Moving on from there, if it's more than 12 months, we would need to capitalize it, right? And that's kind of what all of this is about. And so you're probably thinking, well, what is the term? The term would then be the period which both parties come to an agreement that one will use the underlying IT asset, right? Then you would also add in the options to extend either by the vendor or by us, if you're reasonably expecting it to occur, if you're reasonably expecting to extend. And then same with termination. You would add in those options to terminate, either if it's reasonable based on what you expect to happen down the road and everything like that between you and the vendor. So now, how do you calculate? So we'll move into measurement and calculation a little bit here. And so how do you calculate the subscription liability that maybe you're after you've determined you do have control and you've determined the term, only to determine the liability. So that means we would take the total amount of fixed payments that you'd have to make to the vendor, as well as any variable payments that depend on the index or CPI. And also you would add in the variable payments that are fixed in substance. I don't want to go into that too much. It seemed kind of like a rare item. And so I put the paragraph there. You can, if you think that your contract might have that, go to that paragraph. Because variable payments that are fixed doesn't really make sense. But payments for penalties for terminating if subscription term includes, subscription term that you determined includes the reasonable expectation that it will be terminated, right? Then also you would want to add in any subscription contract incentive receivable from the vendor, and then any other payments to the vendor associated with the contract that's reasonably certain to be required. The future payments should be discounted using the interest rate charged by the vendor, right? That's the easiest scenario. You would hope that every contract is going to show the interest rate in there. Sometimes, which I think most of you or some of you may have determined with leases is more difficult than expected sometimes. So with that being said, you can use the government's estimated incremental borrowing rate. They also kind of went into some detail here where if you had a recent bond issuance, you can use that rate. But if that's not the case, so if you exhausted those options, then you can go to the Oregon Bond Index, and here's the link here, and we'll go to that page here in a second. But then you want to select the rate that most closely matches the effective date in term. So what does that mean? So we'll come back to that last bullet here in a second. But so here's the website that I just put the link for. As I'm sure you all have seen it before, but over on the right here, you can see there are two Oregon Bond Index links, one for July 1, 2022, and one that's current. Those are important because July 1, 2022 is the date that we're going to measure the SBITAs on, and we'll kind of touch on that several times because that's going to be the same for P3s as well. But just remember that date because that's the important date. You don't want to go back further than that. And that's why they've left it static on this website, right? Because that way it won't change because the current one will constantly update. And so if you have another contract later on, you'd use that one. So if you click on that July 1, 2022, here it shows 6/30/2022. Here's your two rates, they're highlighted there. So what I mentioned before with you want to pick the rate that closely aligns with your contract term. So that would mean that if you have an 8-year SBITA, you would opt for the 10-year, right? Not the 20-year. I think. Yeah, so so you'd want to assume that the SBITA started as of 7/1/2022. So what does that mean exactly? It means, let's say your contract did start on 7/1/20. So 2 years ago or 3 years ago, and it's supposed to last for 3 years, ending on 6/30/2023. If that's the case, we would need to measure it as of 7/1/22, making it short term, right? Because it would only be 1 year. So that might trip people up because that's the day you want to use. You don't want to go back further than that. Okay, I think that's most what I want to say there, but we'll touch on that date several times. So hopefully that'll be one thing you take away from here. Then the last bullet here is, once you've done all your research and your due diligence for what rate to use and everything like that, just document it. Document it somewhere. That way, anybody that might be looking for it, why you came up with that rate, you'll have it. You'll know exactly why. I mean, I can't remember what I did last week, so I'm sure the same's for you guys. Okay, so moving on, continuing on with measurement and calculation here. We'll start looking at the subscription asset. So what do you measure the asset at? And the first bullet here says the amount of the initial measurement of the subscription liability. And what's that? That is this here. So we're going to take that amount that we've determined based on these items. And then also include any payments associated with the contract made to the vendor at or before the commencement of the term, if applicable. So what does that mean? That means prepayments. If you've prepaid either the full amount or a portion of the amount, you'd want to include that. And we'll touch more on prepayments here in a little bit. Third bullet here talks about the capitalizable initial implementation costs. And you're probably all wondering, what does that mean? So we'll talk about that here in a second. But then also you would want to take away any vendor incentives received from the vendor at commencement of the term. So then going back to initial implementation costs. This framework here was first implemented with GASB 51 for internally developed software. So maybe some of you might remember that, but I don't know how relevant that is. But it's the same kind of stages here where you have a preliminary project stage and you move on after that. So preliminary project stage, it includes conceptual formulation, evaluation of alternatives, final selection, SBITA, other things like that. And that's all expensed, right? So we're not worried about that. The next step, step 2, initial implementation stage, which is right here, right? That's going to include your ancillary charges related to designing the chosen path, coding, installation. We're going to capitalize all that. Third stage is operation and additional implementation stage, which includes maintenance, troubleshooting, costs related to an additional module implementation. So we'll touch on this here in a little bit as well, because there's going to be times where sometimes you'll have a contract that has multiple modules for kind of either interrelated with the SBITA or they're separate. And so we'll touch on that here in a second. But the separation means that you need to look into your payments and what exactly they entail, right? If the payments to the vendor include training in some way, you need to carve that out and make sure it's not capitalized, because training, as you see here, sorry, I kind of jumped ahead, down here towards the bottom, other items to expense, training is always expensed. On top of carving out expenses that may not be capitalizable, you would also need to, the standard indicates that you can be sure to include other costs from your agency, your own costs. So it could be salaries and wages. If you've had salaries and wages that went into the implementation in one of these, then you would need to include that as well. It might be more than your asset, right? Or it might be more than your liability. Your asset might be more than your liability because you have additional items you're capitalizing in there. That's more than what you're paying the vendor. That's it. Kind of a confusing little diagram, kind of jumping back and forth, but these slides will be available too. So don't feel like you have to write everything down real quick, but so the initial implementation stage for the SBITA is completed as soon as the subscription asset is placed into service. So stage 2, when you stop capitalizing items, once the asset's in service. So as I mentioned before, SBITAs with multiple modules, they're gonna depend on the contract, right? As you would expect. There's different scenarios where if they're separate contracts for each module, then you're gonna do separate SBITAs, right? But there might be a single contract with multiple modules. In that case, you would expense them in stage 3, as it says here. And then, as I mentioned before, down towards the bottom, here's other things that you would always expense. SBITAs should be recognized as of the beginning of the fiscal year in which the statement is implemented. That's 7/1/22, right? I just talked about that with the dates for the rates that you use. Always want to measure it as of 7/1/22. May also include your own agency costs, like I talked about before, salaries and wages. And then also the standard permits that you are able to go back several years. Since you're measuring at 7/1/22, you're able to go back several years for previous expenses that you made for this project. So if you've been making payments, or if you've been slowly setting up a SBITA over several years, you can include those in your measurement if you would like to. It's permitted but not required. So it'd be only really if you feel like you would like to see on your books the total amount that the SBITA is for, right? So if you'd want to include all of the payments that you made to make sure that your asset is the proper value. Obviously, this might not be very easy, could be very difficult, and also may not even provide much value. So it's really up to agencies on if they want to do that and capitalizing all those previous costs. So moving on to remeasurement of the items that we've determined before with the liability or the asset, you wouldn't remeasure only for a change in the government's incremental borrowing rate. There are several things that I've listed below here. Remeasurement is required when one or more of the following items occurs. So it could be a change in the subscription term, could be a change in the estimated amounts of the subscription payments that are already included in the liability that you've determined before. Could be a change in the interest rate that the vendor charges. The vendor might say, oh, the interest rate's different now. And then also a contingency is resolved from the contract that has already been established. So for example, on that, an event that occurs that causes variable payments to become fixed. With a quick Google search, I looked up some SBITA examples in hopes to maybe help you determine, well, maybe things that you didn't think would be a SBITA. So I got this image. Some of it doesn't really make sense. I mean, because Outlook would be included with Office 365. You wouldn't have Gmail as a SBITA. I think the only way that Google would be a SBITA is if you had like a domain name or something like that. But I thought I'd give this out to you all so you can kind of see. I don't know what half of these mean, but maybe you do. Maybe you use them. And obviously this isn't all inclusive. There'd be several more. So I worked with SFMA to determine the new comp objects and GL accounts and journal entries for recording these, right? And so you'll notice that in the handout that these are actually in there. We included the GASB 96 handout or comp objects and GLs in the handout, but not the 94 comp objects and GLs because we're still in the process of testing those and want to make sure that everything works out properly. So, but I want to put these up here because here shortly we're going to go through the journal entries that you would take or you would make in order to establish these SBITAs. And so just some familiarity, but obviously you have them too. So the important thing to note here is that these are very closely modeled after leases. The leases have very similar comp objects and GLs, so they're going to be very similar in the way you report things. But so as you can see, 1701 is the SBITA contract incurred. 2333 is the gain loss on the SBITA. 4376 is the variable payments. 4377 is other SBITA payments. 5356 is the IT asset acquired under the SBITA. 7009 is the principal payment on the SBITA. 7402 is the interest payment on the SBITA. And then 7489 is the amortization for the SBITA. And again, here's the D31s. 0819 is the SBITA asset. 0895 is the cumulative amortization for the SBITA. 1282 is the current obligation. 1728 is non-current obligation. And then also I include the D14s if you care or want to see them. The roll-ups are fairly straightforward based on the names, but I want to throw those in there too. Okay, so we just went over the comp objects and the GLs, and so that's where they're going to show up here, right? You have these entries also in your packet too. So, but still, I thought it'd be helpful to kind of go through each one and determine, or at least kind of walk through a little bit before the exercises, because the exercises are going to incorporate these as well. So first, these entries are also modeled after the leases. Therefore, hopefully nothing's a tremendous surprise. There's going to be little changes here or there, but the general theory and idea behind it all is going to be the same as leases. So first I have it separated into separate sections, kind of like the way leases were. And so the top section, we have at commencement. And first I wanted to note over on the right, there are the different colors depending on the applicable funds on which entry you're going to post, depending on the fund you're in. Proprietary and fiduciary are across the board, all of them. So I won't necessarily touch on those, but I will kind of mention the governmental versus government wide on when you record those. So first, step one, we're going to recognize the SBITA proceeds, right? Which means we're going to use T code 908R, and then we're going to debit deposit liability, credit, revenue offset. We're going to use comp object 1701, and then this is going to be incorporated in the governmental fund that you're in. So special projects fund, capital projects fund, whatever, or special revenue fund, sorry. Step two is we're going to recognize the acquisition of the asset using T code 909R. We're going to debit the expenditure offset, credit the deposit liability using comp object 5356. Step three, then we're going to establish the SBITA liability using T code 462. We're going to debit the GAAP revenue offset and credit subscription obligations. And I think I just noticed that that should be non-current. Doesn't say it there, but you can see by referring back to the slide 1728. Yeah, non-current. And then also we're going to use comp object 1701. You'll see the first two related to the governmental fund. The next two relate to the government wide. So finally, step four, we're going to establish the SBITA asset using T code 545 or 555 if it's fiduciary. And we're going to debit subscription-based asset and credit the GAAP expenditure offset. We're also going to debit the change in capital assets and credit net investment in capital assets. One thing to remember here is that if steps 1 and 2 are paid out of GAAP Fund 0001 and your agency does not have the ability to record revenue in that fund, you need to establish a D23 fund and have it point to GAAP Fund 0054. So I think there was some confusion with that with leases, so I just wanted to make sure that that is something that is a key takeaway, and we'll mention that probably a few times in this training. Before moving on to the next two sections there, I also included, which I think are at the bottom of your entries, the prepaid. If you have we had some questions about if the payments are made in its entirety for the contract or a portion of it, we want to use a prepaid for that. In order to do that, here's how you would record it. Same goes for proprietary, fiduciary. Those are every entry is posted, but for the governmental fund, we would recognize the prepaid from the expenditure, and we left out the fund balance portion of the entry just to keep it a little more simple. But we would use T code 510 for governmental or 500 for proprietary or fiduciary fund. We're going to debit prepaid expenses and credit expenditure offset using comp object 5356. 5356 all the way down for all of these, actually. Then we're going to remove the prepaid in order to transition it to the SBITA asset, which means we're going to use T code 510R or 500R if it's proprietary or fiduciary. We're going to debit GAAP expenditure offset and credit prepaid expenses. Those are both for the governmental fund you're working in. And then the last one is going to be a government wide. and it's gonna establish the SBITA asset, which means we use T code 545 or 555 if it's a fiduciary fund, and debit subscription-based asset, credit GAAP expenditure offset, and then also debit change in capital assets and credit net investment in capital assets. Okay. So now going back here. So the next section here is going to be the SBITA entries throughout the year that you would post. And so for step 5, in order to record the amortization of the SBITA contract, we'd use T code 542 or 541. If it's a fiduciary, we're going to debit GAAP expenditure offset, credit accumulated amortization for the SBITA using comp object 7489. And this is performed in the government wide. And we're also going to debit the net investment in capital assets and credit change in capital assets. For step 6, there are 2 different options that you have. You can either post the principal and interest portion together and then reclassify them, or you can post them separately. Either way, you're going to be using either T code 222 or 415 or 416. You're going to be debiting the expenditure control cash and then crediting the cash on deposit or some variation of that. And then also the comp object's either going to be 7009 or 7402. And note there that all of them are done, all of those entries, no matter which way you choose, is going to be completed in the governmental fund you're working in. The last step of that section is step 7. We're going to reduce the SBITA liability for principal payments, which means we're going to use T code 459 and debit the subscription obligations, that's non-current, and credit the GAAP expenditure offset using comp object 7009, and that's in the government wide. At the end of the year, this last section, we are going to reclass the current portion of the SBITA liability out of the non-current portion. And in order to do that, first we would need to use T code 475R and debit the subscription-based liability or the obligations, which that's the non-current portion again, and credit system clearing GL. And there's no comp object for these. All of these are performed in the government wide. And then we're going to need to record the current amount, right? Which is using T code 475. And we're going to debit to system clearing, and then there's the current obligation portion. Training must be pretty bad. He had to leave, huh? Okay, so we touched on all those, and then we touched on the prepaids here. So here's some more entries that you have. I can't remember if your handout includes the measurement or not. I might have not included those, but we're going to pass over those for now because they're not performed regularly. They're not performed. They won't be performed this year for sure. And so, yeah. Mm-hmm. This one? Which one is it? Mm-hmm.
Subscription based IAT app that should be 081.
Oh yeah. Yep. You're right. Okay. Good eye there. Thank you. So I guess we'll correct that then. Let me make a note so I don't forget. Okay, so like I said, we're going to skip over the remeasurement portion just because it's not going to necessarily affect you immediately, but these will be included in the OAM, so you can refer back to them later if the situation arises. But moving on to termination. As you can see over on the right, there are all of these steps are performed in the government-wide. First step is to move the current portion back to the non-current. To do that, we would use T code 475R and debit the, yeah, that's the current portion, and credit the system clearing. No comp object for that. And then we're going to adjust the non-current, which is T code 475, and debit system clearing and credit the non-current portion. Step 2 is to eliminate any excess asset value and record a gain or loss. For that, we would use T code 537 or 536 if it's fiduciary. And we're going to debit the revenue offset, credit the asset, and the comp object is 2333. From there, we're going to adjust the we're going to also debit the net investment in capital assets, credit change in capital assets. From there, we're going to adjust the accumulated amortization, which means we'd use T code 573, debit amortization of the SBITA, credit system clearing GL. Step C is to adjust the asset value using T code 574, debiting system clearing, crediting SBITA asset. The last step here then is to adjust your liability, which means you'd use 462R and then debit the long-term or non-current, SBITA obligation, and then credit the revenue offset. All right, that was a lot. So moving on to disclosures. Again, we modeled these disclosures after leases, so they should look very similar. We're still finalizing them, but these should be pretty close to what they're going to look like. Here, just a couple things I want to touch on here. It's same as with leases, where you're going to include the nature, terms, residual value guarantees, other things like that. Very high level. We don't need a ton of information on these, just very high level for each SBITA you have. Because high level makes it easier when we're compiling all of them for the ACFR, right? Next page of the disclosure, I know it might be kind of hard to see, but you'll have them soon enough. Similar to leases, section B here has expenses and or expenditures related to variable payments, and then what comp object you record those in. Same goes for termination penalties, and then the comp object you record those in. Step C has your commitments for SBITA before the commencement, and then D is for any impairments that you may have come across during the year. Okay, and the last page here of the disclosures, very similar to leases as well. Just has your yearly schedule, repayment schedule, split out between principal and interest. So hopefully no tremendous surprises there for you. Okay, so moving on to GASB exposure draft questions. There are 3 of them here. We're going to go through each one because we found them pretty helpful, most likely because your agencies might have one of these same questions. So the question is, does a cloud computing arrangement meet the definition of a SBITA? And their answer is a cloud computing arrangement may or may not meet the definition of a SBITA. So maybe. Thanks. Further, it says cloud computing arrangements have 3 common deployment models: software as a service, platform as a service, and infrastructure as a service. All 3 deployment models provide the customer with the right to use a combination of another party's IT software and tangible asset. The definition of a SBITA requires in part that a contract convey control, Janet Jackson, remember that, of the right to use another party's IT software, alone or in combination with the capital asset or underlying IT asset. Therefore, as part of its determination on whether a cloud computing arrangement meets the definition of a SBITA, a government should evaluate whether the contract conveys control. So it really comes down to control. And so you just have to refer back to what control means and what the contract says and go from there, right? Okay, question 2. A government enters into a 6-year subscription-based, or SBITA, sorry, contract with no options to extend or terminate the contract and begins making semi-annual subscription payments to the SBITA vendor immediately after the contract takes effect. But the initial implementation stage is not completed until the end of the 2nd year after the contract takes effect. What is the subscription term? So remember, let's jump back real quick. Initial implementation stage, the important one there. Step 2 doesn't take effect or doesn't complete until after year 2. Yeah, after the 2nd year. So that means, although the length of the contract says 6 years, the subscription term or the SBITA is 4 years, not 6. Because the initial implementation stage is completed at the end of the 2nd year of the contract. Therefore, in accordance with the paragraphs 9 and 15, 96, the subscription term commences at the beginning of the 3rd year and ends at the conclusion of the 6th year. So it's kind of interesting because you may kind of get dead set in your contract and say, oh, the contract says 6 years, we got to go with that. But no, you got to think about the initial implementation stage. So if we kind of use similar circumstances and say we have a 3-year SBITA, but the same situation remains where the initial implementation stage doesn't get completed until the end of the 2nd year. You have 1 year left, that means it's short term, right? So you just expense it, that would be much easier. Okay, last question here. If you have a licensing agreement for a vendor's computer software that automatically renews until canceled, well, a license renews until canceled, a licensing agreement that provides a perpetual license. It's basically asking if you have a perpetual license, or if it renews every year, is it perpetual? And the answer is no, because a provision under which a licensing agreement automatically renews until canceled is an option to terminate the agreement at each renewal date. So think of it as, every year you have the option to cancel it. An agreement that includes an option to terminate is not a purchase, whereas a perpetual license is a purchase in which a government is granted a permanent right to use. So think back to the comparison I had with Microsoft 365 and Microsoft Office, right? One lump sum purchase for Microsoft Office or one-time payment, I guess. And I would think that maybe other contracts are going to have annual renewal, but those would not be perpetual. Okay. So that's SBITAs. Your key takeaways here are always consider your materiality, right? You want to start with the big ones and go from there. Since capitalization threshold is $5,000, don't focus on the little ones because you might not even matter. Be mindful of the short-term exception that we talked about before with the was it the maximum
Possible term is 12 months or less.
Maximum possible term, right? That's the term I was looking for. So make sure that those aren't included in there with 12 months and then a 12-month option to extend. You may also want to talk to your IT department or leadership or procurement because they might have ideas on what SBITA contracts you've had in the past you might have forgotten about or didn't consider. You could also review your accounting records for payments to see about potential SBITAs. I would think it's pretty easy to not realize, you're making these annual payments every year for this vendor, but oh wait, that is actually IT related, so it could actually be a SBITA. Measurement should be reflective as of the transition period, so 7/1/22. I'm going to touch on that again because it's very important. You want to use 7/1/22 as the date in which it is implemented. And then lastly, I just wanted to mention again, general fund treatment in requiring a new D23 fund. So if those first two entries are paid out of GAP Fund 0001, and your agency does not have the ability to record revenue in that fund, you need to establish a new D23 fund that points to GAP Fund 0054. Said that before, but say it again just in case.
Real quick, if that's not your scenario, if you make your release payments out of GAP 1108, 1105, steps 1 and 2 go in GAP 1108, 1105. This is only a scenario where you cannot record the revenue GAP Fund 0001.
Right on cue. My question was, did I forget anything?
Are you using one the same for both, or would you set up two separate D23 funds?
I think, I wouldn't stand in the way of you wanting to have a combined one for GASB 87 and GASB 96. Really, at the end of the day, you have no ending fund balance. I think I've seen one by an agency, Liz or Carly, jump in if I misspeak, where the appropriation number was in the appropriated fund with 9999. It's really just a mechanism to get it. So from that vantage point, I don't care on the G54 code, the G54 description. I think we just saw like I think I saw one reference to like my email that I sent around last year, which I think is totally fine. It's just so to your question, the title, as in 796, is really what's easiest for you. I don't think just and Brady covered well for that measure, that implementation, just make sure we're all on the same page. So the July 1st, 2022 date would be only for those pre-existing SBITAs. I think it's Brady implied, but if you have a SBITA, the subscription term starts on January 1st, 2023. That's when you would measure it, not July 1st, 2022. So it's only for those pre-existing SBITAs. Oh, and really, that's a practical expedient. So guys, we're not asking us to go all the way back in time to go figure out what it was, however long ago. So it's a one-time gift from the GASB, if you will. Yep.
Any other questions?
So we're talking about which rate to use, and we're looking at the bonds used in the Oregon state. If we have one that's significantly less than 10, so if we have a 3-year agreement, what's the guidance of what rate we?
I think 10 year.
You just got to go with the 10. It's really just it's your incremental bar rate, your best estimate. And you know, when Brady's talking there about the documentation, it's the same thing we had in GASB 87. Please do not feel like you need to go write a book on documentation around, I couldn't figure out the rate, so I did all these steps. I've heard, kind of like, you're just trying to get the boat off the dock. You're just trying to, what is the rate? So if you just do a search of the contract, it's not identifiable, I can't determine it. That's the type of thing I would include in the documentation. I don't have my agency doesn't issue its own debt for a similar purpose. I can't use that. I'm going to the incremental borrow. Just, I don't think you don't feel compelled to do a whole bunch of research and try to figure out which rate. You're just trying to figure out which one should go. I think it is a good legal document, so you can show our Secretary of State how you got there. Again, just make it quick. Be nice and advice.
Anybody else? Oh, yeah.
Yeah. To the auto renewal question, if you're auto renewing every year and you have no idea when you might terminate or no longer use that SBITA, how would you determine the term?
Question. As if it renews every year,
Is it a new contract? Is it something that you're just sort of agreeing to the contract on similar terms? Because I think you could make the argument there that it's a separate SBITA every single year, you might be able to get the short-term exception. Now, if it's a option to terminate that you were not taking advantage of, then I think you're back in the spot of saying, what is my reasonable expectation as to how long I'm going to use this? I agree, that's going to get a little bit dicey, but that's, unfortunately, you're going to be in a spot where what's your best estimate?
So what does it come down to, getting a contract every year? Is that what you're saying?
I mean, I think if it's something new every single time, I think you might be able to make that argument.
So it's based, I mean, I don't know about other agencies, but most of ours are not on contract. They're gonna be purchase orders. So, it's just the contract, they don't hear from us, they send us a new invoice, service keeps continuing, and then we pay whatever they invoice us because we didn't tell them to stop service. So nothing changed about the agreement. It's the same as the previous year.
Okay, so does procurement have the contracts?
I would think there's a contract somewhere,
Oh, it's
right?
Or I think you'll probably have to go back and try to find that contract. And go, how long do we potentially have this? And if it is just an automatic renewal every single year, then I think you're probably back in that. I would imagine there's going to be some point which they're saying, hey, we're going to escalate the price on this. Or, is it a 5-year escalation into perpetuity? Or is there I think it's probably working with procurement, whether it's in procurement services to go, okay, what is the contract on this?
Yeah, or even asking the vendor for a contract, right? Because I mean, I would think they'd have to have something, wouldn't they?
So I have something we just got, same thing, similar price agreement. That's all that we have, it's a price agreement. And gas generated it.
Yep.
And work with our vendor for electronic gun lockers that have software associated with them. For 1 year, 1 year, 1 year, auto renew, auto renew, auto renew. So would that fall under the no in that one, or is it potentially, we're gonna have these gun lockers for more than a year, so we just go ahead and say,
I think for the gun locker, you almost got to look at it as potentially a GASB 7, where the gun locker is the tangible asset and the software is ancillary that kind of goes along with it.
the software is ancillary.
Okay, so that would be more GASB 87 than GASB 96, which means you don't have to worry about the 3 phases.
I mean, I'm definitely capitalizing the gun lockers because they're worth more than 5,000 each. But the software, to me, I was just gonna, software license. They're less than 5,000 for each locker. It's
But I think,
separate agreements,
Yeah, I
separate
think-
licensing for each one.
to me, that's a little bit more like almost like a copier, which has software in it. We don't separate those two things. So if the primary asset is the gun locker, it's going to be a GASB 87. I
But we're
think.
purchasing the gun lockers though.
Okay,
They're a purchase, and the software goes with us. They're not a lease.
okay, so then. Okay,
So I think I've got a license agreement on those because they're only 1,000 years.
I think it's something you're almost gonna have to go back to dash procurement services and go, hey, I need to look at the contracts. They won't confirm it because,
But also a capitalization threshold of 5,000, is the software going to be less than that?
Software's less than that per each.
yeah, I think at that point you can make the argument to have to say collectively that they are material, which again, I probably just argue that you don't think these are.
Yeah.
But did you got something in place where Secretary of State's looking at the document, there's inclusion and everything. That, obviously, we don't work with procurement services directly, so that's my suspicion is that they would be the folks that would have the contracts if you needed to. I don't know if people feel otherwise. I'm not pretending to be an expert on contracts. I would expect that that's ultimately going to be the agreement that binds your agency to this vendor for whatever the unit is. But my hope is, maybe it's a little bit of naive hope, is that a lot of these things might be able to get through this short term. Rich, you have a question? That's a helpful chance.
Maybe.
I was gonna say, Rob, I was just kind of going back to that Q&A about auto renewal. Them saying that, you have an option to terminate every year. But if it really is like auto renewal forever until you terminate, you have to consider the maximum possible term. That's where just the catch-22 is my brain. I don't know if that's really a thing, but that's where my brain is going. She's asking.
I thought about that too,
Yeah.
which is why you gotta look at the contract, right? Hopefully there is
I can't
one.
imagine it would be forever, but
Well, what I heard with the origination of this Q&A really came with questions built around Adobe and Office 365. And automatically renews. And would that be a perpetual license? And it gets back to that slide that Brady had on there. And what I heard from the GASB on the stop was if you stop paying, you lose the ability to use the software. I think we all know 365, that's the yes. And so then we know it's the speed if you don't have a perpetual license. And then you're forced back into the term, which is the number that Shasta brought up. To me, I would go back to the contract. And I don't know, my understanding is, please tell me anyone if they're wrong, maybe you know, sorry to put you on the spot. Because I think 365 was a short-term speed thing. I don't think that term extends beyond 1 year. And I know when I've been in some conversation with the guys, that there's some belief, and maybe you can say misplaced belief, that IT vendors don't have the same incentive to have a long-term arrangement like tangible asset leaseholders do, because they know you're probably not going anywhere. Like if you're in a building, my lease term's up, I'm gonna go check out what my other buildings are because they're basically commodity. But we all use Office. We're not moving off of Office anytime soon. Microsoft knows that. So they don't have the same incentive to lock into the same long-term agreement. Maybe I'm sorry right now. I'm gonna say this. I know that there are, so there have been some conversations, I think, on are certain arrangements that are running through DAS, are they DAS's arrangement or are they state agency arrangement? Microsoft 365 being one of them, I think that's still going to be worked out.
Jared's still trying to work that out because of how it's being worded. Or at least 365 agencies. Some agencies did pay for portions while DAS paid for other portions. So it's a little knot we're going to have to try to continue to fund.
Yeah.
Everything every year.
Yeah.
So something.
But some of those things, I mean, I think there's still some things to be worked out. There's some of the structure of state government, some of our IT infrastructure. Like I would imagine Workday is probably all DAS. So yeah, you know, the capitalized first day.
Torture on one day. Yeah, I can't believe you mentioned it.
You know, I'm gonna do this. But, yeah, I think, there'll be some things that gotta work out, I think, through this. I will say another area to be on the lookout for. GASB recognizes they have got very few questions on GASB 96. And you can probably imagine why. Two big things, GASB 87 and the pandemic and all the fun that happened with the pandemic money that came into state and local governments. So they build their implementation guide questions off of inquiries that governments submit to them. So they haven't really got that many. And so that's why we don't have very many to share with you. So it'll be, I suspect, refined as more questions come into GASB. I know they have an implementation guide, which is where we built those off of the draft version. They have those coming out soon. And I think they're as soon being, I think, in the fall. Trying to get some of those out where they're actually effective so we can rely on them.
Yeah, you say there wasn't very many questions for SBITAs. There's even less for P3s, so get ready for that here shortly. Any other questions?
After the first one, I'm just wondering if you know or understand how that might apply. Say, if you have a SBITA for your organization and you're rolling it out to different locations at different times. The implementation stage is done for the first location, and that starts and the subscriptions starts for that location and then you implement it at another location, like, would that be considered different modules or?
My guess is yes.
SBITAs?
It depends on your contract, obviously. If you have separate contracts for each of the different locations, that would be the easier one. It's just one contract. My guess then is that it's gonna be, they add some guidance in there saying, focus on the primary one, so they would probably guess that the first SBITA implemented is your primary, and then the others would be kind of followed after that, would be, which would be expenses, separate modules after that. That's my guess.
What's your objective of the SBITA? Is it to have all of your institutions have this operable?
Yes.
I would look at what's your objective is. That's what I would do. Or, you know, if you feel like it's substantially complete and it's actually placed in service for what your objective is. So you've got 95% of people are there, this is really operating as we intended. What will place it in service? Because that's something where you're gonna, once you place it in service, you move out of the initial implementation stage.
This is for an electronic health record. So of course we want it for all our institutions. But we can't roll it out all across the state at once, so.
Well, I think in that case, you also have a lot of semi-equivalent institutions, right? There's not like you got one gigantic one that's 90% of it all, so that's what I would look at, is saying, we have a better objective with this video.
Okay.
Yeah, I know, just document that.
Any others? Okay, well, it's 11 o'clock, 11:07. What do you think? About 20 minutes?
So what we were planning on doing, we were actually, it's great, we got these questions because we're a little bit later than we expected. So how about this? We'll reconvene at 11:20. I realize it's not gonna be enough time to go through every single one of those, and that's okay. But if you want to stretch your legs, you know, use the restroom, go get a good watch, something like that, we'll come back. I'll just run through the examples. I want to save time for Brady to get through.
I have one question.
Yeah.
I was just saying. You're saying that it's great because the following day on March 2nd.
The close of that day. Because I'm working behind it, it's not space on different days. But yeah, to me, I just felt like it's and I think you go.
It's crazy. Yeah, we don't want to crazy with one thing I should like to start, but they kind of call it. Like, oh, you are. So like, now we know it's about. No, now it's gonna be.
Yeah, so that's all.
Our discovery. I never got scared to go back and just.
I feel like. We have our meeting with Secretary of State. And it's sitting in that meeting on Thursday. Sorry. No, I know. Well, they tried to figure it out, and they were like, but it was funny, she was like, how much? Like, like, when I said, the rock. Yeah. I got into house. There. I kind of don't know. But yeah. Like if you just
I work with Scott a lot. Nah, we had, it's like, dude, I like to take people like you. Right? I'm good.
Well done.
Thank you. My daughter's been trying to ride.
Okay.
So.
Yeah. So there's, looks like it's just gonna change. On there.
There was, yeah, one of the cool projects for the jails.
Okay.
And the entry.
You just-
Yeah. When you're on that other side, it's doing that.
There's a lot. I think that would be.
I know. It's hard because. I think that is a big one here, so they never see it.
So what can happen is, you just see.
Yeah.
Well, I mean, so what do you think?
Might give me that.
20 minutes?
Yeah, I think probably. So, and yeah, and I think if you're, what I would do is jump over the disclosures. Because I think the disclosures are gonna be, I mean, they're not that dissimilar. I would focus on, what is a P3, APAs, going through this, I think will be helpful. And then I think,
I need to touch on them.
yeah, I think you're saying, it's just time to go with these. I think this is a good one as just an example of some of the stuff we talked about. You've already talked on the slides on the Oregon bonded, mixed rate, that kind of stuff. Say, in the GLs, I mean, these pages, remember those, you want to take place.
You should have your 3 Excels up and which ones you're gonna go.
Yes.
All right, everybody, I'm gonna get this started so that we can stick on time. So just so everyone knows, this is a great example of managing up. Brady says, hey, why don't you do these, go through these exercises? Okay, so Brady's request, no, he's been good. So with the scenario one, I'm not sure if folks heard Dawn's question at the start, and she asked about the rate that I use in this when I put it together, 2.83. It is the rate as of the next day, not the rate that would have been in effect on March 1st. I think for me, it's the Oregon Bond Index is a proxy, or said another way, it's a way to determine a rate. So this was the rate that was closest as of March 1st. If you want to use the rate that was in effect, from the previous week, it's just document what's your process and just follow that. And I think from a consistency standpoint. But as you've all read the scenario, and I put this in a way that I hope was consistent with what you're typically seeing. You know what your payments are, you know what your term is. You weren't able to determine the rate. So you went to the Oregon Bond Index rate, put together this, based on the information, you're able to put together an amortization schedule, and then let's put together the entries. So on step one, to record the contract proceeds for the SBITA special revenue fund, like it has in this scenario. So then step one and step two, the 908R and the 909R, as they're outlined in the entries that Brady shared. Mostly I want to just make sure we're all good on number one, special revenue fund, not the government wide. The amount, it's coming from the total principal payment, that 227,196.62. That becomes my fair value for SBITA. Yeah, Jill. Expand it? Yeah. Thank you for mentioning that. We will, yes. Yep. Nope. Yeah, you're welcome. Good question. Is that a little more readable? A little bigger? Oh yeah, this is not the same as the screen that I'm seeing. All right. Nobody brought binoculars to the training. Yeah. Okay. So again, this is coming from the principal. That's our fair value of the present value of the lease. The SBITA, lease SBITA, they're all kind of the same thing. But so that's where that comes from. That is sitting in the governmental fund. Moving on down to number three, to establish the SBITA liability, use a T code 462, happens in the government-wide reporting fund, debits the revenue, credits the liability. All right. Number four, establishing the SBITA asset, T code 545. For the same amount, the 227,196.62. So the thing to keep in mind here is the revenue that's placed in for the special revenue fund is fully offset in the government wide, similar to the capital outlay. It's going to be fully offset in the government wide and moved up into your balance sheet as a capital asset. Recording the amortization. I'm going to show you the formula that shows up there. It's essentially the 227,196.62 divided by 48 months, multiplied by 4. We started on March 1st. I'll say it on the next point. Number 6, adjusting the SBITA payments. I made that note in there to assume that all payments are made to principal throughout the year. So this is really just the year-end adjustment to reclassify into interest. The 1540.35 right there comes from the FY23 interest amounts. We're using the 415.416, we move it into the appropriate comp object. Reducing the SBITA liability by the principal payments using a T code 459, we debit the long-term liability and we credit the expense, which again comes from the FY23 amounts. Something I want to highlight right now is as you'll see in this column, the principal will change over time using the effective interest method. What that means is it amortizes independent of your amortization of the SBITA asset. The amortization expense is straight line. We have a policy in state government that we use straight line depreciation and amortization. So your interest expense and your amortization expense are not the same. And also outside of the beginning, and I'm going to assume that you have no other payments in the initial implementation stage, the numbers will begin the same, but they will no longer be the same after that first payment. All right, because the principal and interest move at a different rate, or excuse me, have a the interest is different than your amortization expense. All right. I just wanted to make sure I highlighted that point. Then just reclassing the current portion, which is the FY24 principal, 54,799.92. Again, that happens in the government wide. So the only thing that's happening in the special revenue fund is steps 1 and 2 to establish the SBITA asset or establish the SBITA resources and to record the SBITA expense at the present value. And then your principal payments. Everything else is happening in the government wide reporting fund. So if it helps, I know with like leases and SBITAs, everything is really smashed together in terms of the arrangement. If you separate them, if you think like, hey, I'm going to go buy a car and I'm going to the bank. So when you go to the bank, I go and I get the, I get the cash, let's say, so debit, cash, credit, other financing source. And then I go to the lot and I go buy the car, credit, cash, debit, capital outlay. It's the same scenario that's happening in a SBITA or a lease. GASB views those as an equivalent financing structure, which is the reason we have to put the revenue in and the expenditure in steps 1 and 2, even though you're not getting any cash. And I get that there's like this disconnect. Why am I putting something in a governmental fund when I get no cash for a resource? I'm not buying anything, but that's the rationale that the GASB is used. All right, before moving on to scenario 2, any questions on this? Yeah, Shasta. Initially, yes. Well, I was looking at it as, yeah, it's a good point. I probably was looking at it like, I see what you're talking about. Yeah, I can see what you're doing there. Yeah. It's just really the timing of the payment. Yeah. Depends on when you make the payment. Good point. Good clarification. All right, number 2. Let me get over to. How's that? Okay. So using the same scenarios, there are no variable payments, but the initial payment was made prior to commencement. Step 1, recording the prepaid expense happening in the special revenue fund. At the point at which the asset is placed in service, you would take it out of the special revenue fund. So one of the questions that has come up recently to us is, hey, we're making all of our SBITA payments up front. And so what should we do? So this is the reason we built this scenario. So if that happens, and again, it's assuming it's a special revenue fund, the 510 puts it into a prepaid after you make the payment. I'm assuming you've already made the payment. Go through like a 222 or whatever you're going to do to make the payments. And then we would, so you'd credit the expense. It should all be sitting in 5356 because it's more than 5,000. And then you'd put it into your prepaid. I do know budgetarily, some agencies, you have budget resources right now, so they are taking advantage of something like this. So they can put it all into AY23, which is totally fine. And then they would use the gap offsets to pull it back for financial reporting purposes and put it into a prepaid. Step 2 would be at the point at which it's placed in service. It's most likely probably not going to be the same fiscal year, but theoretically it could. And so we haven't identified when it's been placed in service, but that would be when you do the 510R to move it out of the prepaid and into the expense for financial reporting purposes. And then using a T code 545 to establish the SBITA asset. One thing you'll notice here is there is no SBITA liability. Okay, because you've already paid it up front. Okay. But we still use the same scenario. What would the rate? What's the rate that would be charged to me? What's the term in order to determine what my SBITA asset is? Okay. Scenario 3 is a little bit more complex. We thought it could be a good exercise. Where's my mouse? Okay. So remember I said the first one we had a 48-month term. That's based on our, let's say it's our expected exercise of the the option to extend. We later decide, we decide that we're not gonna take advantage of that. So we reduce the subscription term by 12 months. Effectively, we have to do a gain loss. So this is a scenario that runs us through the gain loss. The important thing here is everything is going to happen in the government-wide reporting fund. Nothing is happening in the fund statements themselves. Because all we're really doing is we're adjusting the value of the asset. We're adjusting the related accumulated amortization of the right to use that asset and the SBITA obligation. So I think I got a little bit of time here. So we determined prior to the amendment that after I made the February 1st, 2024 payment, that the obligation balance on the SBITA was $172,000 with an accumulated amortization on the asset of $56,799. Prior to making the payment, I would go through and I would revise the amortization schedule, because remember the amortization schedule is built off of my subscription term. And if my subscription term changes, that means my asset and my initial liability also would change. So the revised amortization schedule incorporating the amendment, it gives me an initial SBITA obligation and asset at commencement of $172,782, with a remaining SBITA obligation and accumulated amortization through February 2024 of $116,533 and $57,594 respectively. Now I realize I'm going through this pretty fast, but just for the background, I think the numbers that you really care about are in this third paragraph. As a result of the amendment, the historical cost of this SBITA asset decreases by $54,000. The accumulated amortization actually increases by $795. Therefore, the carrying value of the SBITA asset decreased by $55,209. So in this case, I'm adding the two together. Accumulated amortization increased and the asset decreased, and the SBITA obligation decreased by $55,842. So in this case, you're seeing that the numbers are pretty similar, and that's just a function of the amortization, which I know makes it a little more complicated because the numbers are so similar, but I feel like this is probably not going to be that dissimilar from what you're going to see in reality. So first thing with the T code 537, I take the carrying value. I have a loss on the carrying value to adjust that. So I'm reducing the asset. So that 55,209 comes from my carrying value. And I come down to a 573R, and I increase my accumulated amortization because it increased by $795.40. And then I adjust the value of my asset by the $795.40 as well, which gets me, if you were to take all of these back and then I were to go up or if you were to net these three entries right here, plus the adjustment I made in step 3, it gets me back to a decrease in the SBITA asset of $54,414. All right. So hopefully you don't find yourself in this situation very often, but I thought it'd be helpful to provide a scenario if you do. So if you have questions now, happy to go through them. If you have questions later, which you might, happy to go through them then too. But our hope was that these examples would help the things sink in a little bit more than just kind of having the T codes kind of explain to you and go through the scenarios, but to actually say, here's what I think you'll probably face in your agencies as you're going through and evaluating these types of scenarios. All right. So I'll turn it back over to Brady and he will go through GASB 94. Let's do that.
Was 13 minutes long enough for you all to go through all three of those? Oh, yeah. Okay. All right, so SBITAs took longer than we were anticipating, which is totally fine because we expected that. But so the questions were great as well. So don't feel bad about asking questions. I only say that because I'll go through this a little quicker than I had anticipated. But like I said, the slides will be available as well as will always be available for questions too. So what is a P3? P3 is an arrangement in which the government or the transferor contracts with an operator, which could be governmental or non-governmental, to provide public services by conveying control of the right to operate non-financial asset, such as infrastructure or other capital asset for a period of time. So in other words, a contract in which your agency or government transfers control of the right to use a non-financial asset for a period of time to an operator to provide public services. One thing I found, I mean, I've been digging into GASB 94 quite a bit, and so I've gotten used to the terms transferor and operator, but I know when you're just looking at it for the first time, I wanted to kind of correlate it back to GASB 87. Transferor is your lessor, operator is the lessee. Operator is the one performing the procedures or the public services for the transferor. So here we're going to talk about service concession arrangements a little bit, or SCAs. Some of you may remember back to GASB 60, where they first introduced service concession arrangements. This was also touched on with the disclosures previously with the alpha disclosure F, which was where NA was not an option. So you had to say whether you had it or not. This standard kind of changes that we have new standard or new disclosures that you'll need probably to look into service concession arrangements again if you hadn't in a while, because it's possibly is marked as NA or no, and then just moved on for several years because nothing ever changed, right? So just keep that in mind going forward. But so just a refresher, if you do remember, but an SCA is a P3 in which all of the following criteria are met. So the transferor needs to convey the right and obligation to provide public services using the underlying asset in exchange for significant consideration or payment. The operator collects and is compensated by fees from third parties. The transferor determines which services, prices the operator must provide. Transferor is entitled to significant residual interest of the service utility at the end of the contract. The easiest example I can think of for P3s and an SCA is going to be a toll bridge, right? Where the bridge is the asset and a private party is going to be operating it and collecting fees. It's important to remember that SCAs are P3s, but not all P3s are SCAs. Kind of confusing, but kind of wanted to put that in there and kind of bold it, mainly for this other side over here where we're talking about availability payment arrangements, or APAs. Got a lot of acronyms here, so bear with me. But an APA is an arrangement in which a government compensates an operator for activities relating to an underlying asset for a period of time in an exchange transaction. These activities could relate to designing, financing, operating, anything like that. But the difference is the payments are based entirely on the asset's availability for use rather than on the tolls or fees. These are not P3s. we inquired with the GASB about these because there wasn't a ton of information in the standard about APAs. They kind of just threw it in there. So we were wondering really how pervasive this is to the standard, what we really need to know about it. And they said that they put APAs into the standard simply to differentiate between P3s and APAs. To say that they are not the same thing. Generally, get into that here in a minute. So they're just kind of like an offshoot of P3s, so just keep that in mind. Kind of just need to look at your contract and determine what exactly is going on. This decision tree here, the GASB created this, and I kind of simplified it a little bit or made it a little easier to understand, hopefully. There's a lot going on here, but you start at the top and make your way down depending on how your situation goes, right? So on each of these, I have several more slides that will kind of go down each scenario and what you kind of need to do. So we'll touch on each of those. First, since we just talked about SCAs here, we're going to stick with the situations in which an SCA is relevant or it is applicable to an SCA. Which, as you can see here, is these two scenarios. At the end of the day here, you end up at the same GASB 94 paragraph for each of these scenarios. And as you make your way down, you start at the top. Let's start at the left first. They both meet the lease and P3 definitions. And then moving over to the left, it's the underlying P3 asset is not existing. So that means they don't have it at the time of commencement. And then moving down, if it meets the definition of an SCA, you would go to this paragraph. And so similarly, over on the right side, if the underlying asset does exist, then you would determine whether or not the improvements are made by the operator or not. If they're not, then you move down. And if it meets SCA, you're at GASB 94, paragraph 15 and 38. So I guess, what does that mean? If you end up in one of these scenarios, paragraph 15 is for transferors, paragraph 38 is for operators. So if you're the transferor, you would need to recognize these items listed here, which is the capital asset when it's placed in service, the receivable for installment payments, and a deferred inflow of resources. If you're an operator, you need to recognize at commencement the liability for installment payments that you're gonna need to pay, and then the right to use capital asset. So you're probably wondering, I mean, that's a lot of information, right? What do those exactly mean? How do you measure those? Kind of like how we talked about with SBITAs. I have several slides in here, which probably won't dig into today, but they're in here. So when we send out the recording with the slides or when we post them online or whatever, you'll be able to kind of dig into it and see it. Hopefully it made it a little easier to understand in comparison to the standard itself. But I found it pretty important to kind of go through each of these so you kind of have an idea. If you do end up with a P3 and it is an SCA, okay, I do remember I'm a transferor, I do need to record a capital asset. And either way, you can always refer back to this. So next situation, sticking over on the left side then, it meets the definition of a lease and a P3. The asset is not existing to the transfer at time of commencement, but it doesn't meet an SCA definition. So then you go down to GASB 94, which is paragraph 16 or 39. And if you're a transferor, you go to paragraph 16, which talks about recognizing when it's placed in service, the receivable for the asset, receivable for the installment payments to be received, and a deferred inflow of resources. If you're the operator, then you would go to paragraph 39, which would recognize when placed in service, the liability for the asset to be transferred once it's purchased or constructed. And then also the liability for the installment payments and deferred inflow of resources. Make sure I didn't forget anything here. No, okay, yeah, we're good. Okay, continuing on. Over on the right side now, if the underlying P3 asset existed at the time of commencement and the improvements are required to be made by the operator, you would go to paragraph 14 or 37. If you're the transfer, you're going to recognize at commencement the receivable for installment payments and a deferred inflow of resources. If you are the operator, you're going to recognize at commencement a liability for installment payments to be paid and right to use asset. Okay, so that covers all of those, right? We did the first 4 on the left. If you're all the way on the right, if the asset is existing at time of commencement and the improvements do not require, or the improvements are not required by the operator, and it does not mean an SCA, you're at GASB 87. So it's a lease. You just go back to lease standards and record it like we all know how, right? So as you can see, there's several different scenarios here. And so this I felt was a decent way to kind of relay that. So hopefully as you're going through contracts and everything, you can make your way down there and determine where you need to, or what you need to actually record, right? So here, let's say you've determined what type of transaction you had based on this. But what's the term? This is a very similar slide to what we had before with SBITAs. However, you'll notice one thing that me and Rob actually just realized yesterday, I think, that there's no short term with P3s, which is kind of strange, but in the standard, it said that it's just not practical, or it doesn't happen in reality where a P3 is that small of a term. Generally, they're going to be very long. So the term is the period which both parties come to an agreement that one will use the underlying asset, plus the operators, or sorry, any reasonable certain extension, as well as any reasonable certain termination. We're going to reassess the term if one of the following happens, but won't necessarily go into that either. So as I mentioned before, all of these that I had listed here, the receivable for the asset, liability for the asset, everything like that. Here are the slides for those. Here's how you calculate it. Let's see. When to remeasure, calculating the amortization of the discount, stuff like that. So we won't go into too much detail, but as you can see here, I mean, the fixed asset, I mean, the measurement is very similar to the SBITA. So you should have already an idea of what is going to go in there, you know, the fixed payments, variable payments, everything like that. And then here's what you would record for the P3 asset, deferred inflow of resources, how you would record those, remeasurement, stuff like that. Initial direct costs, I just wanted to kind of give some examples of what initial direct costs are and that they should be expensed. Asset improvements should be reported at acquisition value when placed into service. And then also the asset receivable should be recorded as of the carrying value or the book value at the expected date of transfer. So similarly to the receivable, same type of stuff here. Few variations, but nothing significantly different. So hopefully we all have a decent understanding about that, or where to go to find it. Here's what you need to do for right to use asset. One thing I will point out here is that when you're determining the right to use asset, that first bullet point right there talks about the amount of initial measurement of the installment payment liability. And what is that? That's this right here. So you determine this. You also need to determine the asset, and this is incorporated into the asset. So the asset liability, if you need to transfer it at the end of the term, transfer it back. Deferred outflow of resources. Okay, so we kind of talked about this with SBITAs as well. Multiple components with P3s and how to account for those. Really what it comes down to is the contract. There are times where a P3 is going to include P3 and non-P3 components. If that's the case, you want to separate those out unless the contract specifies otherwise. And then if it involves multiple assets, you would account for them separately. And here, APAs with multiple contracts, kind of same thing, report them separately. This last bullet is pretty important. APAs are not P3s, like I said. That means they should be expensed. I'm guessing probably 99% of the time. They threw in the caveat where it might meet a definition of a lease in one way or another. So if you think that might be your case, just we can talk about it or look at GASB 87, 94, compare APAs to 87 and go from there. But generally they're going to be expensed, which is good, right? Easier. So we already talked about this. Same type of thing with the rates that you'd use. You'd want to use the vendor, then go to the incremental borrowing rate. So I won't go into too much about that, but all of it remains true, where you want to select the rate that is closely aligned with your term and document it once you got there, how you got there, which one you used, everything like that. So I just included these in here as well. Same type of thing we already saw earlier. So same thing as SBITAs. They need to recognize as of the beginning of the fiscal year in which the statement is implemented, which is 7/1/22. So 7/1/22 is the year you want to use. Again, it may include your own agency costs as well, you know, salaries and wages, like I mentioned before. One thing it doesn't include is I talked about how SBITA can include prior year expenses. That's not the case for P3s. They don't do that. Just moving forward. Don't look back on these. So a quick Google search here for public-public or public-private partnerships will bring up a few examples. Now, I put these in here just to kind of help you think of potential situations you might have. However, we don't know for sure if these actually meet the definition of GASB's P3s, but just go through them real quick. So a park improvement, the Gateway Arts Park Foundation in St. Louis raised $250 million in private funding, and then also $86 million in additional sales tax to revitalize the city's tourism. So they kind of work together, and that's where the Gateway Arts came from. IT, Seattle announced a deal with Gigabit Squared for providing high-speed internet to all residents. Then education, Phoenix has 2 schools that share 300,000 square feet, which was once the Maryvale Mall. And then lastly is the example that I gave before about transportation with tolls. Tolls is the easy one. Seems to be the most prevalent as well. So I put these in here, you know, in hopes that it'll kind of make you think more and say, okay, yeah, I do have something maybe similar to that. If you do, you definitely need to look at the GASB and make sure it actually falls into what a GASB considers a P3. Don't just go by what Google says, right? But anyways, I thought those might be a little helpful. I also included the comp objects here, as I mentioned before. They're in the slides and they will be provided later on once they are finalized, as well as journal entries. But don't have a lot of time. We got about 6 minutes, so skip through these. I mean, you'll see them at some point. Didn't include the entries for the same reason. I want to jump over the disclosures because they're pretty much the same as leases, pretty much the same as SBITAs. You know, general information here, very high level. Few additional items here: termination penalties, residual value guarantees, and same thing here. These were all for the transferor. You're going to have separate disclosures for the transferor or the operator. Both look very similar, as you can see here, but these should replace Alpha Disclosure F, as I talked about before. And yeah, like I mentioned, we couldn't find any Q&As for these, and I think it's similar to SBITA's where no one's really asking GASB any questions about them. So I guess we will keep looking. So we'll keep you posted if we do find something that would be tremendously helpful for everyone. So key takeaways for P3s then, always consider materiality like before. Start with the big ones, considering the $5,000 capitalization. You need to talk to your leadership, procurement, intergovernmental to determine maybe there's something you're not thinking of, some project that you forgot about, right? Again, review accounting records for similar things for potential P3s. And P3s should also be recorded and measured as of 7/1/22. And with all that being said, how can I see a show of hands on how many think that they have a P3? One. That's all right. So we're also working on a survey to send out to everyone in order for SARS to get kind of a grasp on how pervasive P3s will be to the aquifer. So we'll be on the lookout for that. Yep.
So one of the reasons we're asking about that is we've had some just conversations with some others in state government. We're not sure what our exposure is. You know, if we look at the service concession arrangements under GASB 60, where NA was not an option, nobody had a single service concession arrangement already take on. So we're really just not quite sure where things are, because part of the reason we prioritize 96 and not so much 94. So we don't want to take a lot of your time on something like, great, I don't have to worry about that. So we are putting together some information to be able to input into our stars. Obviously, tolling is a major topic with our friends at ODOT that's out there right now. So we'll probably be in a space of having P3s at some point in the next decade or so, but we just don't know where our exposure is. So part of that survey is going to go, what do you think? Yeah, do you think you have some? So just again, get a little bit better understanding that it's out there.
Okay. Any questions on those? Probably a lot, so we went through it pretty quick, but nothing right now. Well, if you do, we'll have these slides available, so you can look at those, contact your SARS analysts, look at the OAMs that will be out for comment soon. And here's also my contact information. What do they say about extroverts? Extroverts like thrive on large groups. I'm pretty introverted, so it's the opposite. So probably won't see me for a couple months, but yeah. All right. Thank you.
Right.